Ever wonder why your bonding agent looks at your profitable financial statements like it's a house built on sand? In construction, your numbers tell one story to the bank and a completely different story to the bonding company. Kind of like how that perfect looking concrete pour can hide serious problems beneath the surface. Today, we're breaking down how bonding companies read between the lines of your financials, what they adjust that banks don't, and how to strengthen your position with both. You'll learn practical ways to present the company's true financial strength instead of just looking good on paper. This is the Contractors Test Form. I'm Wade Carpenter with Carpenter Company CPAs, alongside Stephen Brown with McDaniel Whitley Bonding and Insurance. Stephen, what's the most common financial mistake contractors making that tanks their bonding capacity even when their banks look healthy?
Number one is taking cash out of the company. You need to know how much cash you need in the company to know what kind of bonding capacity. To take cash out and then ask for bonding credit is always a struggle, but it happens all the time.
Again, as I was telling you, this sort of was born out of a team meeting I had with my people this week. We were talking about contractor financial ratios and how I look at it and how you look at it. And then as we went into some things, our bank really looks at some of these things very differently. And so that's where we're approaching this somewhat differently. I think it's a good exercise for our listeners to understand why we look at some things a certain way. It's really about the health of their company. And so my message is they should be knowing what these numbers look like. It's sort of like your dashboard for knowing if you're healthy and growing and profitable. What are your thoughts?
Wade, that's a really good point. Perceptions are everything. You had mentioned to me earlier that's so true that banks, when they're analyzing your financial information, they're looking backwards and bonding companies are looking forward. What you meant by that, which is so true, is just how your financial information is analyzed to get what you want from a bank or a bonding company. We've talked about this a lot of times in the past. Surety bonding for contractors. It's called surety. Like construction is the overall term for building things, surety is the overall term for everything that needs to be bonded by a surety company. And the way a surety company analyzes your financial information is so different from a bank. You put your financial statement together that looks good for your surety and your banker and looks good for you and how you manage your company. Those three go together like that. Well, there's two. Okay. So anyway, they go perfectly together. Everyone says, you've got taxes too. We got that issue to deal with. There's always the issue of how you balance what your financial statement says and still get everything you want. And there is a way to do it.
Yeah, and part of my message was the banks are looking for collateral, and we could talk about the components. You were talking about that before we started this. What they're looking for is the ability to pay somebody back or pay them back. They're basically looking in the past, and you have to look at the past, but also look into the future and say what's coming along and can you be able to bond this and complete the job where you're basing that on what you think is going to happen in the future. So you really do have to look at it a different way.
Absolutely. You would think the bankers would look at your backlog gross profit and your estimated cost to complete the work that you've got on the books. But then again, they don't seem to do that like they did in the old days. There were construction-oriented bankers that really looked at both sides when making a decision to lend you money. But from a surety perspective, your backlog of work is the number one predictor of the future. It predicts, first of all, you can look at the past and say, do you generally have a lot of profit fades? And I'm jumping around, but all this is so important for a bonding company. They're looking whether you maintain the profits you seem to make. Maybe one, maybe two jobs losing money can be explained, but a lot of jobs means there's a serious problem that has to be dealt with. And we can talk about that some more. But also looking at your backlog of work shows you what kind of profit you have coming up within the next, say, 12 months, a snapshot picture. It's called a work in progress report. You look at that and you also analyze how much debt, current liabilities are owed in those 12 months versus the income and estimated expenses. And a bonding company can pretty much tell from that how you're going to be able to finance your work. That's the thing that makes some contractors crazy. Well, I do federal contracting. I don't finance anything. I do work for municipal governments. I don't finance anything. Have you ever heard them say that? And yet at the same time, you need cash.
Absolutely. I think that's one of the things that we'll get into is how do we look at working capital differently. But from an overall standpoint, and I'm not trying to knock bankers, but most people think, okay, the banker's going to be the ones that really are digging into this stuff and they're really trained to do this well. But actually, the bond agents are, they basically take a harder look at some of these things and a
Hmm.
more sophisticated look. What I see banks out there doing is they will take a tax return. And it doesn't matter if it's on the cash basis, accrual basis, or really even percentage completion basis. They don't care. They're looking at so far in the rear view mirror and just basically what's your history. There are a lot of things that they don't pick up on. I've had conversations with bankers all the time. It's like, okay, you're looking at a cash basis financial statement. These are a cash basis tax return. And these contractors obviously never want to pay tax. So they're running the profit down every single year. If it's a cash basis, we may not have the receivables or the payables on there, and it may not be a true balance sheet. And when we get into the working capital stuff, I think we'll talk about like some of the stuff that they would leave in there that obviously, if you're trying to figure out if this is a healthy company, doesn't make sense to me that you would do it, but bankers do it anyway.
That's so true. Another thing our listeners need to absolutely grasp the difference between bankers and bonding companies is the paperwork involved. What kind of financial reports are needed? And also, if a bank lends you money, you walk in the door to any bank, you sit down with the loan officer, they don't know you, and they're going to ask for a million pieces of papers. They're going to dot every I and cross every T before they give you a loan. And what you think will take place in an hour or two takes a month or two to get worked out. With the bonding company, they might can move faster. It all depends on how fast you can communicate your information. For example, there's credit scoring bonds that require little or nothing beside a good personal credit score for you and your spouse. If you have multiple partners, they're going to look at everybody's credit score, both partners and the spouses. It just depends on how much they own of the company. If your partners own 15% or less, they won't scrutinize that. That's the credit scoring model. But for looking at surety credit standard, they have to have balance sheet, income statement, work in progress report showing jobs completed since the last time they saw your statement and your work in progress. In the old days, it was called a work on hand, but it's a whip. Everybody knows it as a whip. No bankers that I know of really understand the whip and how to read it and what it means. And I apologize to you bankers if you're listening and you do regularly analyze backlog, gross profit, and lending. I want to meet you. Please reach out to us because we certainly need you in Atlanta and Memphis operating territory. But nevertheless, surety bonding is about, as we mentioned, it was looking to the future. Okay. Can you finish the job? And here's a situation I may mention to you. We have a young fella in our office who was a construction only CPA who is now a bonding agent. And he was reading the financials and he was scratching his head. He goes, how in the world are they giving bond credit for numbers like this? And I said, first of all, you got to take off your hat. You're no longer an accountant. That's not your job anymore. Your job is to get bonds approved that make sense. You and I both know that this job's right up their alley. They do it all the time. They can do it in their sleep. They're going to take a chance and say yes on this because it's not just about collateral like a bank would require, but it's about your character. So we mentioned the three important things for bonding: cash, character, and capacity to do the work. Character means you do what you say you're going to do traditionally. That means a lot. Cash means you've got enough working capital to support your backlog. And the capacity means the job that you want to bid is something that you're capable of doing. You have a track record of doing it, or you have a game plan for doing it that makes sense to a bonding company. So it's all about communication. And we talked about that. Banks have those three plus collateral, and they're going to weigh their loan more heavily on collateral than the other three. Where in bonding, all three are pretty much equal. You would say the cash situation will rule more than the other three, but not in a good long-term, serious standard surety bonding relationship.
I think I want to get into some of the nuances of this, but just since you mentioned it, and the more I'm thinking about it, again, this is no disrespect to bankers. I got to hand it to you is in the surety industry, you were talking about how fast you turn it around. And sometimes you are having to make quick decisions and get stuff at the last minute. this is sort of a personal thing. I'm actually buying a commercial building right now. And the bankers, okay, we'll rush it through and get it done in 8 weeks. Really? I was a little disappointing with that. But anyway, that's a different story. They are looking at sort of the same ratios maybe on the balance sheet, which, one of the main ones I want to talk about is like the working capital and the debt to equity and some of that stuff. Can we start with the working capital? I wanted to throw out some of the things that I see that a banker might leave in. Obviously, you probably would throw out, or if they actually looked at it, they would probably not take as collateral as well.
Sure. For our listeners, let's define what working capital means. It's your current assets, which is anything that's considered liquid that can be converted into cash readily. It's cash, accounts receivable, even cash value of a life insurance. Anything that's liquid, stocks, investments, anything that's liquid is considered current assets. Current liabilities is any debt you owe over the next 12 months. So the difference between the two is working capital. If that number's large, then you can get more bank credit and you can also get more bonding capacity. Where banks will lend more on hard assets like equipment and office buildings, property, real estate, they will lend on that. It does take longer to get that loan in place, but it's a real good thing to put that in place to secure a line of credit. That's the first and foremost thing you need as a contractor, is a line of credit. It also helps you with your surety capacity. So those two go hand in hand. You remember that expression, and this just shows how old I am, Wade. If you have to look in the yellow pages for an attorney, it's too late. Nobody even knows what yellow pages are. If you have to hunt and search an attorney online locally that specializes in contractors and you need one, it's too late. That relationship needs to be in place before you need one.
Yeah.
They're putting a new heating and air conditioning system in my house today. My negotiating power when it's 100 degrees outside and everybody's slam has just gone down the tubes. It's the same with an attorney. You meet with an attorney, you hire them, you listen to their advice, you have them scrutinize your contracts, and they know two things from you. You're going to pay your bills on time and you take their advice. Okay? You're in. Banks, you have good paperwork, you dot the I's, cross the T's, pay your bills on time. They make money off of you. You're in. Surety bonding, you finish the jobs we bond and you retain cash and working capital in your company to support those jobs. You're in.
Yeah, let's get into some of the nuances if we can. So, like working capital, let's start with that. Some of the things that I see that a bank might leave in working capital and your current assets, things like prepaid. You had prepaid rent or prepaid taxes or something like that. The money's spent. And the way I see it is the bonding company says, okay, the money's gone. You can't get that money back. So it's not an asset. Whereas that's one of the nuances is like when you got a construction CPA, you're doing some planning at the end of the year, or if you're going to have prepaid taxes versus getting it refunded, even if you're going to turn around and pay it right back, a tax refund is probably something the bonding company would include. Things like inventory. What contractor has inventory? Banker might leave it in. At best, I would say a rule of thumb is like 50%, but usually there's probably no credit for inventory.
Generally, you're right. And our listeners would say, that isn't fair. That isn't right. Man, you surety folks are a bunch of jerks. But here's the thing. The bonding agent needs to explain how those things that have been taken off your working capital adjustment that you just mentioned are going to apply toward a particular job that's coming up. So you may have inventory that's discounted to 50% or less as cash. But if you have inventory that's set aside specifically on a project you're getting ready to do, that you're not going to have to bill in inventory, you can get some more bond credit. It's going to help move things over into the right end of the column. There's some construction companies that are regularly going to have receivables over 90 days. I'm thinking railroad contractors. There's just certain customers and vendors that are not going to pay as quickly, but they know that the receivables good. So you have to be able to pick out who the receivable is and make a pitch for that. What if it's a municipality that owes you money? They'll give you credit for that if there's a reason for it. A lot of times your receivables will show up as overdue. We've talked about this so many times about over and under billing your jobs and how that affects cash flow and your receivables.
Like I said, the receivables, the retainage, a lot of people that are doing this don't look at the retainage. If it's like you're going to collect it over a year in the future, that's really supposed to be a long-term asset. And there's a lot of people out there that are doing financial statements that don't know that and never classify it properly. But one of the things that also leads into the next topic I wanted to go into is loans to shareholders, because it gets thrown out. I've seen bankers leave that in. And a lot of times that's where your shareholder has taken more money out than they've taken in cash. And sometimes it's because of tax purposes, so that you're not paying tax on something you didn't deduct or getting double taxed on it. But these loans to shareholders, a lot of times that gets thrown out. Why? Because obviously, whether they're going to get that money back or not, the bonding company's got to be able to have that as some kind of asset they can say, hang their hat on it. But it also can affect your equity. I had one contractor that he didn't understand. He had a $700,000 loan to shareholder. Why are you throwing that out? What's your thought on that?
Think about it from the bonding company standpoint. They are underwriting your business first, not you personally. You might say, it's right here in my personal checking account. Really? Okay, then pay back the loan to the company. I don't want to. I like it sitting in my personal bank account. If you want surety credit, pay it back. You can make a capital contribution loan to your company. You can subordinate that debt where you agree with the bonding company, I will not pay that off over 18 months, 2 years, 3 years. You have an agreement with the bonding company. That paid in capital will stay there and you get immediate working capital credit for it. But you keep playing games where you take all the money out of your company, then you want bonding credit and you agree to whatever they say and you put it back in. You do that back and forth so many times, you're going to destroy your relationship. You may get bonds approved every now and then. There's always a bunch of different folks you can call and say, so-and-so won't do my bond. I need it. Let's figure out a creative way. We'll get it done for you. That works a couple of times, but it destroys your relationship in the long term.
The two major things as a bonding company usually is working capital and then your debt to equity. So we were talking about the loans to shareholders, and that's going to probably be thrown out of your equity as well, especially if you got a large amount of it. But you just also talked about subordinated debt, which also can be thrown out of some of the liability side if you're doing that. I have seen that can offset. You just have to have a subordination agreement.
Sure, the subordination agreement is something that you agree to the terms and conditions. You will make a capital contribution to the company and you will pay yourself X% interest on that loan. The bonding company agrees that you're going to pay interest on it as if it was a loan and an expense, but they're still going to give you working capital credit for it. Under the conditions, you agree not to take it out. And that's the big deal here. If you sign a subordination agreement and you agree to keep the money in there for 18 months, 24 months, 3 years, whatever you agree to with the bonding company, then you cannot take it out. You've agreed to the company in writing that it will stay in. And you say, that's just a gentleman's agreement. No, it's a legal document. You are subordinating that debt, which means you are saying, I will not pay this debt back. Now, however, at any time your working capital gets above the point where that subordinated debt isn't needed anymore, they'll retract the agreement happily. They don't care. They just want to make sure it's there. That's all.
Yeah. The other option is like you've got a whole bunch of money loaned into the company versus you owe the company. And if you're loaning to the company, you could convert it to additional paid in capital or stock, depending on how you're set up. That's a more permanent thing. So a lot of times the owners don't want to do that to eventually get their cash out. But that's just another thought about it.
You may have enough profit coming in from your backlog of work that your working capital is no longer a problem and it's
Right.
fixed itself and you can pay yourself back. But then the worst thing I see is someone will get a big hit on a job and they'll make a big profit and they just distribute it. They just take it all out. It's the first order of business. We're getting it out of the company. And I beg you, just talk to your bonding agent first. They're not going to make you feel guilty or tell you what to do. They'll just tell you exactly how it'll affect your bond credit.
Can we go back to the WIP schedule and what over and under billings do and how a bank may just gloss over that number if it's on the balance sheet at all? There is a point where there's too much of a good thing. From a cash flow standpoint, it's great to say, hey, we overbilled $1 million or whatever. Or if you're underbilled, there's pros and cons. You want to talk through that and explain a little more what I'm talking about now?
Sure, billings in excess of cost is a current liability. Cost in excess of billings is a current asset because you've incurred that cost, but you haven't billed for it yet. And in either situation, if those numbers are 20 or 30% more of your equity in your company, then the bonding company's going to make some adjustments for it. Those adjustments are in terms of how much bond credit they extend to your overall backlog of work.
Yeah, this personal situation that one of my contractors had, it was a school contractor that had a May year end. It was sort of weird,
This
but
wasn't Radcliffe, was it? I'm kidding. That's the hero of your book. I'm sorry. Go
that
ahead.
was the company in the book.
Yeah,
Yeah, they were a general contractor too, but this particular general contractor built schools. And obviously, school building, you're doing your heaviest work when the kids are out of school, which is the summer months. Actually, this particular county, all their administrative people took off in the summer too, or the school board people.
and the
Actually
summer is
had
now just June and July.
Yeah, the county would allow them to bill like 3 months ahead so that they could go ahead and get everything done. So they were actually like, I don't know, at the time it was 6, 7, $8 million overbilled on the statements. And obviously that was making the bonding company nervous. But when we explained to them, like, okay, they've given them the cash flow and we're getting, I mean, this is a strong company anyway. This is why. If you can explain why you're so overbilled or why you're so underbilled. The underbilling, I think, is also a problem. Like, are you having problems actually collecting? Is that a billing problem? That's probably affecting your cash flow.
What about unapproved change orders
Yeah.
showing up as over and under bill? That's a really good point, Wade, because how it's interpreted by the bonding company, you're exactly right. It makes so much sense. For a bonding company, they're just looking at your financial statement to see what you report as over and under billings. And then they reconcile the two. And you say, wait a second, there's a reason for this because we didn't post this to this, and we didn't post this to this, and this wasn't billed. Okay, that makes sense. So you talk about it. Bond underwriter, your bond agent, the contractor, bookkeeper, the accountant, you just talk about it. You work it through. The most important thing is to regularly go over your financial statements with the bonding company, not just at the last minute when you need a bond, and develop a true partnership. That's where magic happens in the surety industry.
Yeah, absolutely. And just along those lines, unapproved change orders, I've seen this more times than I can count and actually admit, but there are contractors out there that don't book their retainage. And I've seen reviewed and even one case audited financial statements where the retainage was not on there. And so they were way underbilled. It looked like they were way underbilled, but they weren't including their retainage. Obviously, finding these things out is really, like, are you really healthy? I think that's part of the exercise in talking about this, but I would like to maybe spend a little more time talking about backlog and backlog gross profit and how a bonding company, I mean, you've already said a banker would never look at it. If you know you've got the next 6 months of overhead covered or something like that in backlog gross profit, you want to talk about that?
Well, your backlog gross profit is only as good as how you've performed in the past. So a banker looks at the past, bonding companies look at your backlog gross profit on your traditional ability to produce X amount of work a month. And so it's important when you look at backlog that the surety company is looking at your working capital to support that backlog. It's a percent of your overall backlog that they want to see in working capital, but that's constantly changing. So the more you communicate, the better chance you have of getting more work and a lower working capital ratio because you're showing this amount of money is coming in. And traditionally, we are making that amount of money with no profit fades. Did I answer that question?
Yeah, absolutely. And you actually led into the next topic I wanted to go into was profit fades.
Okay.
That's one of the things that we put a work in progress schedule on the financial statements. It all looks rosy. And then the next statement the bonding company gets, that job completely tanked. They were supposed to make 25% or 30% gross profit. They ended up losing money on that.
What if the project took place over multiple years or through your fiscal year end and you took more profit in one year and less in the second? That's something that has to be adjusted for by the bonding company as well.
Absolutely. My point is if you do it like once or twice, it's one thing, things are going to happen in construction. But if you have a history of doing that, the bonding company's going to think you can't bid your job properly or you're purposely pumping this up.
You got
Confidence in it.
people error or you've got
Well,
system error.
yeah. That particular contractor that I was talking about, they had the opposite problem. They were actually trying to tamp down their jobs when they did the financial statements because they didn't want to pay taxes on them. They were on percentage of completion. So they were actually having profit gains, and the bonding company loved it. But if the IRS ever caught on to some of that, that's sort of like the problem that very few contractors have, but it's more, does the bonding company trust your bidding?
Absolutely. And does the bonding company trust your project managers? What project manager is managing what particular project? What's their track record? And again, it's just typical among males to not talk about personal problems and issues. But you will see a loss on a job from one of your very best project managers that is going through a personal crisis. It affects everything. And you got to make allowances for that and know ahead of time what's going on so you can support them so that doesn't happen. And also have systems in place that support the whole process of the control that project manager has on the job. A good project manager that loves the type of project they're doing and has a track record of turning in those projects at the profit margin that's been estimated, under promising, over delivering. That's what you want to do. That's worth its weight in gold as well. So I mentioned the magic of surety bonding, and all of this comes together to make good things happen.
Yeah, I know we've hit a lot this time. We're getting a little long on this one. Hopefully, if you're listening to this, you got some insights that you never thought about before in your business. And the purpose of all this is looking at yourself and are you really healthy in your business? And are you building profit and wealth? We appreciate you listening to us. We hope you learned something. If you got some insights, we'd appreciate it if you put it in the comments below or had questions about what we do. We'd love to hear it. We do this every single week. If you would like, share, subscribe, do all that stuff, we appreciate it. And we will see you on the next show.